Hey folks, Dan Frio here on the Mortgage Update. Today we're going to talk about mortgage terminology. So I'm going to phrase this video as mortgage terminology or mortgage wording for dummies. Because here's a common conversation that I hear a lot of times, even around our office. We'll get a phone call, and then one of the loan officers will say, "You know what? We're having a problem with your DTI because when we priced your loan out with the investor and ran you through DU, we were having some issues. And so when you finally get to underwriting, we'll never be able to get a CTC because the appraised value came in a little bit low, and also we're having some delays because the title company hasn't issued the title yet." Even when I listen to that, I'm like, huh? What did you just say? So why I wanted to do this is I recently went to a mechanic, and the guy's sitting there telling me about some pipes or wires and this and that. I'm like, dude, just put it in English. So I wanted to do it today, and I'm going to try to get through as much of these as I can. I'm probably going to have to do a secondary video because when I was brainstorming, I came up with about 20 different things that I'm sitting here in. For me, it's common knowledge. For you, it's probably you're sitting there saying, what did he just say? I didn't understand probably 90% of that conversation, but you don't want to come across as dumb. So you probably don't ask a question. Me, on the other hand, with my mechanic, I'm like, dude, just put it in English. I have no clue what you just said. So let me go through some of the terminology that we use. I'll explain it to you, so next time you talk to me or a loan officer, or you even just want to get a mortgage, you kind of have an idea what's going on. So I'm going to add something to here real quick. Okay, the first thing is, and again, this is just in random order, debt ratio. You might find out, you know what, you got that phone call and said, you know what, I can't get you approved through the DU system because your DTI is too high. Here's what that person just said. Okay, I'm going to explain DTI and then DU and the investors and what all that means. So your DTI is your debt ratio. It's basically your budget. Can we fit you into a budget that Fannie Mae and Freddie Mac require to approve your loan? And I'll answer that question in a minute. Fannie Mae and Freddie Mac, who they are. But let's focus on your debt ratio or debt to income. It's basically just that. It's your debts. But where a lot of people get confused is what debts is it? So anything on your credit report. That's why I always say, go to that website, creditscoresandmore.com. It's plural, creditscoresandmore.com. You can choose number 2. That will give you your real credit reports that we use. TransUnion, Equifax, and Experian. Those are the 2 credit companies that report all of your credit. Okay, so let's get back to your debt ratio. So you get all those accounts, only what's on your credit report. Not your cell phone bill or your car insurance, things like that. What's on your credit report plus what your proposed or what your mortgage payment is. You add that up. That is your debt. Now to income. Debt to income is your debt ratio. Now what is your income? That's pretty simple if you're W-2 or basically you're salaried or hourly. The easiest thing there to do is, and this isn't precise, but just take your 40-hour work week, multiply that by 52 months in the year, divide it by 12. Use that as your income for now. Again, this is just for demonstration purposes. If you have overtime, bonuses, side jobs, side businesses, other areas of income, that's where I would love to get involved and help you to figure out what is your income. Let's just make it simple, though. You have an hourly pay, or you work 40 hours a week. Your pay is X. Take that hourly pay times 40. So you got a whole week's pay times 52 for the whole year divided by 12. That gives you your monthly income. So in the debt to income piece, that's your income. So we have your debts that we already explained divided by that income we calculated. That is your debt ratio or debt to income. You can get approved, in most cases, you can get approved up to 50% of that. So if your house payment and all your creditors on your credit report divided by your income is 50% or lower, you should be okay, depending on a whole bunch of other things like credit scores and other items. Okay, so that's your debt ratio or debt to income. Your LTV or loan to value. That also is loan to value. The loan on your house, so let's say your loan amount is $100,000, to value, the value on your house is $200,000. We take the loan, 100 divided by value, 200 equals 50%. That is loan to value. Your loan amount divided by the value of your house. That one's pretty simple, but again, when we reference LTV, you're probably thinking, what's he talking about? That's what I mean. You might hear a lot of loan officers, and again, I hear this around the office, is, well, your pricing today is bad. What's pricing? That's how we internally reference your interest rate. Rates today are bad is basically what that person just said. Meaning rates are on the increase. You know, we might, think of it, we try to target the markets because the markets are very similar. The mortgage rates are tied to mortgage-backed securities. It's a bond. So we follow that daily. So what happens is, it's like the stock market. If the stock market went up 1,000 points today, most likely tomorrow it's going to come back a little bit. So we might say pricing was terrible today, it was off the charts, that means rates just skyrocketed. So we're going to wait for tomorrow because there's probably going to be a pullback. So pricing is basically our referencing the interest rate. So if we say pricing's bad today, rates are up today. Pricing was really good today, rates were down today. So that's pricing. Let's see, underwriting. What is underwriting? Underwriting is basically, there's two components of underwriting. There's two entities out there. It's Fannie Mae and Freddie Mac. You've probably heard of one or both of them. They probably do 90% of the mortgages in the country, believe it or not. So you might hear people say, oh, Fannie Mae, Freddie Mac, they're bad. They're this. If it wasn't for them, there would be no mortgages 10 years ago. So those are the two entities that everybody uses, almost everybody, to get your loan approved. So here's how it works. Those are basically their websites that we use. So we use a computer system to plug in all your data, your name, birth date, social security numbers, job, your income, your credit report is pulled through there, your bank accounts, everything about you is on this application. We then take that application and we upload it into Fannie Mae or Freddie Mac's website. You might hear people reference DU or LP. And I know I'm getting a little bit in depth, but DU is Fannie Mae's version of that website. LP is Freddie Mac's version of that website. So you can choose either one. And they have a little bit of differences in between the two, not much. So we take your data, we upload it into those systems. Those systems then, the computer system reads your data and issues us an approval, or it doesn't say decline, it says refer or caution or something like that. So if it's caution or refer, that's bad. You're looking for an approval. So what happens at that point is now we have a computerized approval, okay? But we have to now validate all the information that we put into the system. So meaning you put in that you make $4,000 a month. Well, we got to prove it. How do we do that? Pay stubs, W-2s, tax returns. You say the house is worth $200,000. We need to prove it. How do we prove it? How do we prove it? Appraisal. So those are all things. So basically, we get a computerized approval. We then get all the documentation that we need to validate those items that we have to prove. Your income, your appraised value, the money in the bank, all that other stuff. We package that up, and we actually now send it to a person to review. That person is called an underwriter. That's their job. They go through your computerized version of the approval and now validate all of the things to make sure everything was inputted correctly, because garbage in, garbage out. If the information wasn't correct, then the approval is not correct. So that's what they do. They validate everything. That is what they call underwriting. A person basically, there's automated underwriting, which is that computer version, and there's a manual underwrite, or an underwriter that does all the validating of the process. Let me check my time. Okay, so you might also hear CTC. You're clear to close. What's that mean? Well, now you're done. Now basically all we're going to do is you're going to go to the closing, sign the papers, and get the money or the keys to your home. So it just means your loan is done. It's cleared to close or ready to go. Title. Let me try to get through this. Title isn't required in all, well, I'll talk about Illinois. In Illinois, you have to get title on the property. It protects the lender and it protects you as well. What happens is they go to the courthouse and they pull all of the data on that property. What I mean by data, any liens, any mechanics liens, they check the taxes. Are they paid? They want to check the background. So what will happen is, once, let's say you're buying a house and you bought this house, and 4 years later, some guy knocks on your door and says, you know what, we put a roof on this house 5 years ago. You owe $15,000. You're like, I didn't even own the house. Well, that's where the title comes in involved. Basically, title insurance insures you that from the day you took out that loan, going forward, you have no issues or no concerns about the past. They're ensuring you that you have clear title, you have no issues with your title, or think about your car. You have a title to the car. So now you have a title to the house. You have no issues on anything in the background ever affecting you. They might come back and say, your taxes were delinquent 5 years ago. I didn't own the house. Well, you file a title claim and that they'll take care of that. Somebody comes to you, knocks on your door, says, I put that roof on, you owe me. No, you're going to get a hold of that title company because they insured you that you were okay from the day you close going forward. You don't have to worry about the past. So that's title or title insurance. Here's another big thing, and I'll go through this. Inspection versus appraisal. Okay, an inspection isn't required. So basically, it's you're looking to buy a house. You hire a professional inspector. Usually they're contractors, they're handymen. They really know a lot about a lot. They know about plumbing, they know about electrical, they know about drywall, paintings, roofing, everything. So what they're going to do is they're going to go out and they're going to go into the cabinets. They're going to go into the circuit boxes. They're going to go into the attic and crawl around. They're checking for leaks, cracks, bad wiring. They're checking for everything and anything that might hinder that property. Cracks in the foundation, cracks in the on the outside stairwells where maybe water can seep through. That's what they're doing. So that's an inspection. You don't have to have it. It's very much, it's a good idea to get that, especially if you're buying a house. They might catch something, and a lot of these inspectors do catch a lot of stuff. Some things is, really important, I feel. Others are kind of a little nitpicky, but, it's a good thing to get. Okay, now appraisal, that's a whole different story. You normally, in almost all cases, you need an appraisal. Why? You want to find out what the value of the house is. We want to find out what the value of the house is. Let's think of it this way. You're buying a $100,000 house that appraises for 90. Do you want to pay 90 for 100 for a house that's only valued at 90,000? Probably not. Nor do we want to lend you more on that house than it's worth. So an appraisal is required by the lender to validate the value of the property. And they also go through it and check the condition of the house and let us know if it meets all of the guidelines for the particular program that we're fitting you into. So those are a lot of questions that, or the terminology, again, I'll call this mortgage terminology for dummies. Hopefully I kind of put it in perspective to you. So next time you talk to a loan officer, hopefully it's us. But if you're talking to a loan officer or the lender, you're sitting there and you're not like, what did he just say? So I hope you find this informative. If you do, please don't forget to give me a thumbs up down below. Don't forget to subscribe if you would. That helps me reach out to more and more people. If I can be of help, please, you can call me personally at 630-338-1160. That's 630-338-1160. You can find me on the web at themortgageupdate.net. Or you can email me. It's pretty simple. It's Dan, D-A-N, .frio, F-R-I-O, @gmail.com. Thank you much. God bless. Have a great day.